Welcome back to AS Gold, your weekly edge on the gold market. In this video, we break down the complete outlook for gold, that's XAUSD, heading into the week of June 15, 2026. Inflation, the Federal Reserve, geopolitics, and the key technical levels you need on your charts. Let's get into it. First, the snapshot. Gold is trading around $4,215 an ounce, essentially flat on the day, but well off its prior highs. Through the back half of May and into June, the metal slid hard, and the driver was a hawkish repricing of Federal Reserve policy. Here's the verdict for the week ahead: the bias is neutral to bearish in the near term, but there is a firm structural floor underneath this market. Gold is caught in a genuine tug-of-war, bearish macro pressure on one side, a powerful structural bid on the other. 4,200 is the pivot. So what's the story, and how do we frame it? The slide was all about the rate path. Hot inflation and a resilient labor market forced markets to price out rate cuts, and that lifted the opportunity cost of holding gold. But the decline keeps getting bought, because central banks and safe haven demand are relentless. With the Federal Reserve's decision now just 2 days away, expect tighter ranges and pre-event positioning. The path of least resistance is sideways to lower as rate hike odds bite, but dip buyers should cushion any decline. This is a two-sided market. Respect both directions. Let's start with the bullish side, and there are two powerful pillars. First, geopolitics. The conflict involving the United States, Israel, and Iran keeps a risk premium under gold, and the World Gold Council says that premium is, quote, set to continue and possibly expand. Second, and even more important, central bank buying, the structural floor under this market. In April, central banks resumed net buying, adding 19 tons, led by Poland at 14 and China at 8. For the first quarter, official buyers took down 244 tons, up 17% quarter-on-quarter, and the council projects 700 to 900 tons for the full year. This relentless demand is exactly why every dip gets bought. Now the bearish side, and it starts with inflation. May's Consumer Price Index, released June 10, came in hot. Headline inflation accelerated to 4.2% year-on-year, the highest since April 2023, and it rose 0.5% on the month. Energy did most of the damage, with gasoline up over 40% year-on-year, tied to that Iran conflict. There is one silver lining for the doves: core inflation, which strips out food and energy, was more contained at 2.9%. But that hot headline is the proximate trigger for gold's recent slide, because it feeds straight into the Federal Reserve. And the Fed is the main event. The FOMC decision lands Wednesday, June 17, and its chair Kevin Warsh's first meeting at the helm. The market overwhelmingly expects a hold, in the 3.5% to 3.75% range. But here's the shift that matters most for gold: the risk has flipped from cuts to hikes. Markets have priced out all of this year's cuts, and they now assign better than even odds to at least one rate hike by year-end, with roughly a 43% chance of a move as soon as December. Higher rates raise the opportunity cost of holding non-yielding gold, and right now, that is the metal's single biggest headwind. That hawkish tilt is backed by hard data. The May jobs report blew past expectations, printing around 172,000 jobs against forecasts near 85,000. A resilient labor market gives the Fed room to stay restrictive. It shows up in the bond market too. The Treasury curve is upward sloping, with the 2-year near 4.05%, the 10-year at 4.45%, and the 30-year at 4.95%. More importantly, real yields are elevated. The 10-year inflation-protected yield sits near 2.16%. High real yields are a textbook headwind for non-yielding gold, and the firm dollar piles on top of that. Now to the charts. Spot sits around 4,215, after tagging a multi-month low of 4,027 on June 10, right after that inflation shock. To the upside, the level to reclaim is 4,500, now overhead resistance. The pivot, the line in the sand, is 4,200, with price hovering just above it. Below that, the bull's last stand is the June 10th low at 4,027. On momentum, price is trading below its short-term 50-period moving average near 4,190, but holding just above the 200-period average near 4,079, and the RSI is neutral, around 48, no extreme either way. So how could the week play out? 3 scenarios. The base case, at 45%, is range and chop, gold holding between 4,100 and 4,300, with the structural bid defending dips while the hawkish macro caps rallies. The bear case, at 35%, is a hawkish Fed or a hot dot plot that breaks 4,200 and opens a retest of 4,027 and below. The bull case, at 20%, is a geopolitical escalation or a dovish surprise that lets gold reclaim the 50-period average and push back toward 4,500. Remember, these probabilities are analyst synthesis, not verified fact. Here's the bottom line for a trader this week. With the Fed 2 days out, the single most important rule is to respect the event, reduce your size into the June 17th decision and don't fight it. Tactically, sell rallies into the 4,500 overhead while the hawkish macro dominates. Buy dips only on a confirmed hold or reclaim of 4,200, with higher conviction down at the 4,027 low. And watch real yields and the geopolitical headlines as your tell. A spike in either direction can override the chart in an instant. Let the level and the headline set your direction. Finally, confidence and caveats. We are highly confident on the macro picture, the hot inflation print, the hawkish Fed path, elevated real yields, and the relentless central bank demand. But the Fed decision is just 2 days out, and a hawkish surprise can move gold fast, so these levels can shift quickly. Several unverified market rumors were deliberately excluded from this report. And one important reminder, this is analysis for education, not financial advice. Always manage your risk. If this breakdown helped, smash that like button, subscribe, and turn on notifications so you never miss an AS Gold Outlook. Trade smart, and I'll see you in the next one.